My name is Jake. Welcome to the channel. It's a beautiful sunny day down here in Austin, Texas, where my wife and I live. My wife and I, we're both looking to achieve financial independence and retire in our mid-40s. We're currently in our mid-30s. We have a time horizon of about 10 years. Here on my YouTube channel, I share with everybody very transparently what I'm doing to achieve financial independence, but I do it with a little bit of a twist. My wife and I, what we're looking to do is build up or amass a dividend growth portfolio that we can live from and not have to liquidate the shares, and then thereby generate generational wealth that we can pass on down to our kids. This video is really for everybody that might be researching target date funds or considering investing in target date funds in the future. I'm going to share with everybody everything that I wish I would have known or even asked before investing in the target date funds, or, also known as target retirement funds. And I will be very honest, when I got my first job, I started investing into target date funds because of the simplicity. I really bought into the idea of you select one fund and then that's the end of it. You never have to look at it again. And it's very appealing, especially if you're a new investor and you don't understand what they are and you're very new to finance. I think it can be very attractive, but I want to share with this video a few things that just your average Joe, your average person can do to really take control of their own future, their own financial future. So in this video, we're going to cover 5 things. The first thing that we're going to talk about is what are target date funds? And then the second thing is who should invest into target date funds? Who are they good for? And then the third thing is I'm going to show real life examples of my own from myself of where my employer offers in their 401k and through my HSA. So I'm actually going to go and share my screen and show what investment types or opportunities that I have through my employer and kind of give examples of, what that would look like. And then the fourth thing is I'm going to share why I don't invest into target date funds and really break down the reasoning behind that. And then lastly, the fifth thing that we're going to talk about towards the end of the video, so stick around, is I'm going to give a tutorial on how to create your own target date fund in M1 Finance for a third of the cost that you would with a traditional retirement date fund. Really, I'm speaking to new investors here, new or beginner investors that really want to take control of their own finances, don't want to have to rely on a financial advisor. And honestly, it's not very complicated. It's not a complicated topic. I'm going to break it down very, very simple. And after the video, I promise you're going to feel like this new investor here.
That's nice.
Oh man, that is great. Gary Payton, man, it was so fun watching Gary Payton and Michael Jordan play back in the 90s. Really, really great time. So what is a target date fund? Sometimes they're called different things. Sometimes they're called retirement target funds, but a target date fund is a basket of individual funds in one single fund. So that might kind of sound a little bit weird. So essentially you're purchasing one fund, and within that fund, you're getting a bundle of different assets within that fund. And as time goes on, the allocation, the weighting in that of those funds will change. Target date funds are really meant to make life easier for investors that just want one single fund to invest in that is going to do everything in the back end, and they're not going to have to really follow up on it. And it's going to optimize their portfolio allocation based off of their time horizon. This is very, very simple, it's very straightforward, and I think it's very appealing because it just is that easy. You select one fund based off of the time that you're looking to retire. You don't have to decide, okay, how many bonds do I have to have in my portfolio? What is the allocation that I need to equities? How much international do I need? Instead, all you have to answer is, when do I want to retire? Based off of the answer to that question, you're then going to decide, okay, you're going to select this fund versus this fund. It's really that simple. Okay, so let's take a look at 2 different funds here. Let's look at the first one where you're going to be retiring in about 30 years here. So this is my wife and I. This is the traditional age where we would be looking to retire around 65, give or take, here with this target retirement fund of 2050. So when you pull up this fund, what it is you're going to have to take a look at a few things. So the first thing that you want to take a look at is you want to see what are the expenses. What is the expense ratio to hold this fund? This fund comes with a 0.15% expense ratio. This is fairly low. I mean, this is not a really crazy high expense ratio, but it is much higher than just, for example, your S&P 500 through Vanguard, for example. And so some things that you want to be aware of is you want to take a look, okay, what is the current yield? What is it yielding? What has been the historical performance, right? You can take a look at the chart. You know, since its inception back in 2006, it's averaged right around a 7% return, which is not bad. I mean, that's actually a decent return. Okay, it's a little bit under the overall market, the S&P 500, but it's not horrible. Okay, but what I want to focus on is exactly this. So when you're doing your research on these type of funds, this is all it is. It's broken up into 4 individual funds. So the first one is the total stock market. This is VTI or VTSAX. This is, if you follow the FIRE movement, this is the holy grail of index funds for the FIRE movement. This is VTI or VTSAX. This is the total US stock market. This right here is the total international market minus the US. So this is the VXUS. The third here is the total bond market. This is BND, ticker symbol BND. And the fourth one here, the international bond market, it's BNDX. What this is you're purchasing one fund that is broken up into 4 different funds. And based off of your time horizon, the percentages here will be adjusted. Okay, and the big benefit of this is it's done for you. You don't have to do anything. You purchase one fund, and then as you get closer to retirement, these allocate the weighting here in the funds will adjust as you get closer to retirement. Let's take a look at the other example here. So this is the 2030. And you can see it also has a close expense ratio at just 0.14, so still very, very low considering all things considered, considering other retirement date fund options out there in the market. But when we go down here, we can take a look and we can compare, okay, well, when was it created? It was back in 2006 as a lower performance compared to the previous one. And the thing that we want to focus on here is exactly this. What is the allocation? So what are you getting with the 2030? So with 2030, you're getting the exact same funds in this index fund, in this retirement date fund, but the allocation, the weighting is different, okay? And so instead of what did the other one have? The other one had 54.5. This one has 40. So that's really the only difference, is the weighting changes as you get closer to retirement. And so when I was first learning about this and learning about target date funds, and I thought about the concept of, okay, well, it automatically adjusts based off your time horizon, etc. It sounded so appealing because it means I didn't have to do anything. And I thought that was really, really appealing. And that's why when I first started investing in them, that's the reason why I invested in them, is because I thought, okay, I couldn't do anything better myself. So I thought, okay, I'll just go with this. So now let's talk about who should invest into target date funds. Now I shared a little bit about why I did it, because it was very, very simple and straightforward. It sounded great. I didn't have to do anything. It was very, very hands off. And that's exactly the type of person that should invest into target date funds. I think that if you're the type of person that does not want to have any involvement in your investments, but you don't want to go through a financial advisor and you don't want to pay a financial advisor, I think target date funds are right for you. It's really that concept of you pick the fund once, you invest into it, and you never have to think about it ever again, and you just dollar cost average into it for the rest of your career. And then once you reach retirement, you open up your portfolio and you're a millionaire, right? Like, I think that's the type of person that would be best suited for target date funds. Another reason why someone would want to invest into target date funds is there's more focus on risk management and diversification. So if you're relying on the fund to adjust as you get older, really it takes away the risk out of the investment, and it's very, very well diversified. You saw that there was exposure to the bond market, different asset classes, also international, right? Very, very well diversified fund with just one investment. So really, I guess if you're the type of person that says, I want to invest in it and never look at it again before retirement, I think target date funds are right for you. I think for the audience, for everybody that is watching this video, I think everyone here thinks a little bit differently. I think the fact that you're watching this video should show yourself that you're taking the time to educate yourself and you're working on your financial literacy. And I think everyone watching this video, I believe that no one watching this video should invest into target date funds. I'm going to get to exactly why in just a second. First, let's take a look at real life examples of my own situation with my employer. So I have an HSA, a high savings account through my employer. And with an HSA, you're also able to invest. With my HSA, I have different investment options. And so, for example, when I pull up the investment options, it gives me a whole array of different options. So, you got, especially if you're a new investor, this can be so overwhelming, right? You're looking at large cap, large blend, real estate, foreign, small, mid blend. Like if you're a new investor and you look at this, you're just like, oh my gosh, what is going on? And you just start really easily getting overwhelmed. And trust me, I'm speaking from experience here that it can be really overwhelming. And so if you're new, you might be scrolling through this list and you might look down here and you see, okay, the Vanguard Target Retirement 2050. And you might do a little bit of research and see, okay, what is a target date fund? And you might see, okay, well, I know that I want to retire by 2050. All of these other ones I'm not completely sure about. Well, I'm going to go ahead and I'm just going to pick this because it seems a little bit easier. And so I'll be honest, that's what I did when I first was looking over this list, and not this list specifically, but years ago when I was doing this for the first time. That's the exact situation that I was in, and was thinking to myself, well, damn, this is really, really overwhelming. And so these are the different options that are available in my HSA. So my 401k plan is offered through my employer through Vanguard here. And so let's take a look and see what investment options are available through my employer. And when I select new fund, so currently what I am investing in, I invest in the Vanguard S&P 500, and I invest in the Vanguard Real Estate Index Fund through Vanguard as well. And this is in a Roth IRA. This is how I have my Roth IRA set up. And so if I were to go in and if I were to select new funds, let's see what other options are available. Now, I know that every employer doesn't offer the same options, doesn't go through this, have the same plan. I share this with you just simply to make a point that it's a little bit more complicated, or can appear more complicated than it needs to be. Okay, on my employer's plan, I have different options. I can invest directly into the S&P 500, which I personally choose to do. I could invest down here into just bonds. I can invest into treasury. I can invest into mid caps, stocks, or I could select one of the 10 here that's available on the target retirement funds. And if you're a new investor and you're looking at your own employer's 401k investment options and you're thinking to yourself, okay, wow, this is a little bit overwhelming. This is a lot. I share this with you because a lot of new investors, they get confronted with this question, okay, what should I do? They don't want to make the wrong decision. And so they take the safest route, or what appears to be the safest route, and just go with the easy choice. The easy choice is, I think I want to retire at this time in 2050. I'm going to pick that one, right? And I think that's why a lot of people kind of fall back on target date funds. So now that we know what a target date fund is, now that we know who a target date fund would really be great for, and we understand, what kind of different opportunities are available traditionally in a 401k when comparing target date funds to other options, I'm going to share why I personally do not invest into target date funds. Now, this is independent whether or not I would retire at the traditional age of 65 or at the age that my wife and I are striving for in early retirement at, in our early 40s. Now, if I were to take this scenario with my current use case of looking to retire in give or take around 2030, what that would look like. And the reason why I don't invest into this target date fund is really for two reasons. The first reason is the expense ratio. The expense ratio is, is it 0.14? Okay, well, I mean, it's not that high, but it is still something, right? It's still a reason of why I avoid target date funds is because of the expense ratio. Because I believe that with a little bit of homework, I can get comparable results without having to pay a higher cost. That's the first reason. The second reason why I don't invest into retirement date funds is specifically for what you're seeing on the screen. These 4 individual funds, these are all great funds themselves. All 4 of them are great. Okay. But for me, for my goals, what my wife and I are looking to do, these funds will not, the way that they're set up will not help us to reach our goals. Now, take away the dividend aspect out of it. Let's say we wanted to just go, the more traditional route and liquidate our shares, right? I would still have that same opinion. Okay. The reason why I don't invest in target date funds is because of the asset allocation. The asset allocation, the bond exposure. If I were to invest into this fund, I'm going to have 30%, over 30% into bonds. Currently, I don't invest anything into bonds. I really, really do like the total US stock market here with 40%. I really like VTSAX or VTI, but I personally believe that this should be a much higher weighting in your overall portfolio. So those are really the two reasons. The first is the expense ratio. The second reason is the asset allocation. Now, let's take a look at why the expenses matter. You might be thinking, okay, well, Jake, the expense ratio is not that big of a deal, yada, yada, yada. I think it's important to see this in raw numbers so that you can really understand the impact of the expense ratio. Let's take a simple scenario of somebody that has an initial investment of $10,000 and their dollar cost averaging every year or every month. Let's just keep it simple. They're investing an additional $12,000 a year for 30 years with an annual investment return of, let's say, 9%. Let's just say 9. And then it has a duration of 30 years. The difference here is going to be a little over $30,000. Now, $30,000, that compounding over time is much larger than you could actually think, and you would actually think. So the fees really do matter, and this expense ratio of 5, that will make sense in just a second, but that's a big reason of why the fees matter. Now, let's say, for example, that you were able to do double that. Let's say you were able to invest $2,000 a month. Right? Maybe you're not able to do that today, but maybe you're able to do it in the future. This is where you start to see the numbers creep up on you, right? The more that you're investing and the longer time horizon, the more you're going to be spending in the expense ratio, okay? And the fees absolutely matter here, okay? And so this is a big reason of why I'm so conscious of the expense ratio in my investments. All right, let's head on back over here to M1 Finance. Let's take a look and see if we can build our own target date fund here in M1 Finance and what that would look like. And it can also be applicable if you want to just see how you can build pies here in M1 Finance. It's kind of cool. Let's go ahead and let's walk you through how you can do that. So if you go to your main page here, you go over to the research tab here and you select My Pies. You can go here and you can create different pies here in M1 Finance. And here you can select from individual stocks, you can select from individual ETFs, you can select from individual, you can put a pie within a pie and you can select from that, or you can select from the expert pies that M1 Finance offers. I personally don't use them. So let's go over here and let's take a look and let's add VTI. VTI is the total US stock market. We're going to add VTI to our basket here. Now, VTI is the equivalent of VTSAX, but the ETF version here. So let's add that to our basket. Let's add another one. Let's add VXUS. This is the Vanguard Total International Stock Market here. Let's add that to our basket. And let's go over here and let's add BND, which is the total bond market. This is here in the US. And let's take a look at let's get the total international bond market index as well. Add that, and let's add those together. All right, so this is our new pie that we just created here in M1 Finance. as a default, they all are equally weighted. But let's go ahead and let's change some stuff up here. So let's edit this pie and let's change it around here. So let's go on over here and let's take a look at and let's replicate the same allocation that is in the Vanguard Target Retirement 2050 fund. And if we go over here and we can see, okay, so VTI, it makes up just about 55% of that fund. VXUS makes up 36%. BND makes up 6%, and BNDX makes up 3%. And so let's say this is the 2050, and let's go ahead and let's save that. All right, so you can see the numbers here changed a little bit. The dividend yield changed, and so we got still the 4 holdings. So right here, you can see the expense ratio is 1/3 the cost that you would pay if you were just to pick this retirement fund. And all you would have to do, if this is the only thing that you ever wanted, all you would have to do is every couple of years come in and adjust the allocation, but you're getting the exact same thing at 1/3 of the cost. So that is a way that you can create your own target date fund here in M1 Finance. And honestly, if you wanted to change it up and say, all right, well, it's looking like we're going to be able to retire a little bit sooner, you could adjust it here accordingly if you wanted to follow the same methodology that the target date fund follows, where you're lowering your allocation to the total stock market and increasing your allocation to the bond market. So the key things with target date funds is to understand asset allocation, also known as portfolio composition. That, even as a beginner, you can take control of your finances. You don't have to leverage, or you don't have to speak to a financial advisor. You could do this yourself. I just shared with you exactly how you can replicate a target date fund on your own, right? Through M1 Finance. And the second thing here that I do want to highlight and reiterate is that the fees, like inflation, are the silent killer, and if gone unchecked, can have exponential consequences over time. Looking at it from a year-over-year basis, it doesn't really move the needle that much, but over a 20, 30-year time period, or you're looking at that over a generation, right? You hand this down to your kids, right? Then we're talking a very, very large amount that you're paying in fees that you don't notice on a day-to-day basis. Thank you so much, everybody, for watching the video. If you're new to the channel, I'd invite you to subscribe. If you like today's video, give me a thumbs up, and I'll catch everybody in the next video.